Welcome to a video that I call the What to Watch video. Every week I do a number of different videos. I do a video each day. I do a weekly video. I do an intermarket analysis video. I do another video called a deep dive video where I look at charts that I really didn't focus on in the past week in case we're getting some insight from those charts. And then this video is the What to Watch video, or this is more of a high level look at the things that I'm really watching for right now. This video will at least be prepared once a week. It'll also be updated on an as-needed basis if changes occur in the market and warrant an update to this video. This is being prepared for Monday, March 4th. The first thing I go through is I look at those things that are positive. Now, right now, we have a list of positive things. We're watching to see if these positive things are going to, in fact, turn negative. Then later on, I have a negative list, and we're going to see if those negative things turn more positive. The first thing is that the markets are anticipating rate cuts to be slow. It does look like the Fed is done raising rates. It looks like they're going to cut them at some point in 2024. We don't know when, but they're cutting them more because the economy is holding up rather than because of some emergency situation. Now, that could always change, but for right now, the idea that the Fed will be lowering rates and the economy is not too hot, not too cold, the market really likes that. And that's why we're seeing prices going up for right now. The S&P did set another new all-time high on Friday, March 1st. The technicals that we look at, which are all of our charts, we are still looking quite positive when you look at all of them together, but we're looking a little too positive. And you could say overbought. And in some instances, that usually calls for some kind of a pullback. If we do see a pullback, we'll be waiting to see, is it going to shift into an actual decline where the environment changes, or are we just pulling back before we're getting set to go higher? The S&P is above long-term resistance. In the video that I did a week ago, we were right below this long-term resistance. We hit it a week ago on Friday, and we bounced back down from it. Well, in Friday's session, we were able to get above that resistance level and close above it. Now we're wondering, can we stay above that level? The growth to value ratios that we watch are improving, and discretionary to staples is also improving. Now, when you see growth in value and discretionary and staples doing better, that tends to give more support to the market and prices tend to go higher. The S&P is in a solid uptrend. And the bullish percent indexes, I think this is one of the more important indicators. This measures point and figure buy or sell signals. It's not based on a moving average. And we're looking a little bit better, and I follow bullish percent indexes for the S&P, the NASDAQ 100, and the NYSE, and it does look like they could be improving. At the same time, if they turn and start to go down, that could signal some weakness coming into the market. And the NASDAQ finally made a new all-time high. So we're seeing the S&P, the Dow, the NASDAQ 100, the NASDAQ, and other indexes hitting new all-time highs now, and that's always a positive thing. The Japanese Nikkei did surpass where it was back in 1989. Took a long time, but we finally were able to get above that level. Here's a chart. This is something that Chris Schiavocco mentioned in his weekly video a week ago from Schiavocco Capital. I found this chart on Twitter. This is a study put out by NDR, and really it just measures that when the Fed is cutting rates slowly, the market tends to do better than if they're cutting rates quickly. And if you think about that, it makes sense. If they can cut more slowly, that usually means that they're adjusting to what's happening in the economy. If they have to cut them fast, that usually means something really bad happened, like 9/11 or the Great Financial Crisis or the COVID lockdowns, things like that can really put a lot of pressure on the market. Now, this can always change, but for right now, the market is anticipating a slow rate cut. This is a weekly chart of the S&P 500 with a monthly pivot point. This is what I was really focusing on a week ago. We came right up to this level and then fell back down below it. Well, in Friday's session, we were able to get above this level and close above it. Now the big question is, can we stay above this? Are we going to break above it and keep going up higher than that? If we fall back down, is this producing some kind of a fake out? Other times when this has happened, this was right at the end of 2021, we came right up to this pivot point, and then we went into 2022, which was a difficult year. Earlier in 2023, we came right up to this pivot point and then spent the next couple of months coming down. We've come right back up to this point again, and now we're at that indecisive point as the market figures out what it wants to do. So this is what I'll be watching. Also, we're keeping an eye on growth versus value. When you want to buy low and sell high, growth does better. When the market's under pressure or going sideways, folks tend to prefer value stocks. The blue line is growth, the red line is value, and they're both doing better, but we want to see the blue line going above the red line. What I'm showing you here is a 10-minute intraday chart of growth versus value that are measured independently of each other. We also look at a ratio for the S&P 500 of growth to value. This is a 10-minute intraday chart where we are starting to see some improvement. In Thursday and Friday's session, as the market was going up, we saw this ratio also going up. We're going to keep watching that to see if this keeps going up and the market keeps going up. If this starts to go down, is the market starting to go down? Then here's an end of day chart looking at the small caps, and they had a really good week this past week. But you wouldn't really know that by looking at their index on top. They were up 3%, but we've just been chopping around in a range. We really shot up last December in 2023, but we really haven't broken out in 2024. We've been going sideways in the growth to value ratio. We finally were starting to break out, and now we're seeing some improvement with the small caps, and we're wondering, can this continue? Is this looking better for the small cap index? We also look at mid caps, which are looking a little stronger, and their chart is looking a little more healthy. We've also been seeing a longer term uptrend when we compare growth versus value. We're wondering if that can continue. We look at S&P growth to value ratio on an end of day basis, and we came up right to these previous highs, and we're starting to break out above that. Right now, that's looking healthy for the market. If we start to see some declines, we'll be watching this ratio. Then we look at discretionary versus staples. Discretionary tends to do better in better environments. These are things that make life fun, or staples are the things that you have to have. We have been seeing it on the bottom area here. This is a ratio between discretionary and staples. Discretionary has been outperforming. We're wondering if that can continue. And then we're looking at the broad market now, and we're seeing some improvement. We have a cumulative advanced decline line for the NYSE, and that is showing a breakout right now. And we're also looking at a regular advanced decline line for the NYSE, and this is also improving. We're wondering if that can continue. This would be more positive for the market to see this line continue to go up. Here's the trend line. This goes from the October low and then just extends under the lows that we've hit along the way. We're still above this trend line. So this will be an area that we're watching. If we start to pull back, are we going to fall underneath this trend line? Then here's the bullish percent index, where we were seeing a negative divergence. The S&P was going up. The bullish percent index was coming down after giving us an extreme positive reading. Now it's starting to turn back up, and it's just crossing back above 70. If this can keep going up and price keeps going up, that could be positive. If this starts to turn and go down, that could be more negative for the market. We also look at the bullish percent index for the NYSE, also seeing that negative divergence when compared to the S&P 500, where we are starting to turn back up right now, and we're wondering if that will continue. We're also looking at the NASDAQ 100 bullish percent index. It stayed really positive for a long time. It finally dropped below 70. It's now starting to come back up, and we're wondering if that will continue. Then we look at the S&P 500 on top, which is setting all-time highs. And finally, we're seeing a new all-time high with the NASDAQ, and that's positive. Here's the Japanese Nikkei, where it finally was able to surpass the high set way back in 1989. The negative side, things just to be aware of here. We're still looking really extreme when it comes to sentiment. Folks are pretty much assuming the market's going to be going up, and the market doesn't like that. We get to the point where you start to take the market for granted, and that's just about the time it starts to reverse. You also have a lot, I don't have it on this chart, you have a lot of things, a thing that we call FOMO, the fear of missing out. And folks are afraid of being left behind, and so they're going to jump in, but they're using their emotions to do this. They're using fear and greed to do this. And when we see that starting to happen, a lot of times that can mark some kind of a top, whether it's short, intermediate, or long term. We have to let that all play out. But for right now, folks are getting pretty happy about the market. The skew index is another measure of fear. That's causing us a little bit of concern, and I'll show you that chart. We do look at the McClellan oscillator, which is more short to intermediate term, and then the summation index, which is more intermediate to long term. The two go with each other, and they are negatively diverging from the S&P 500 as well as the NYSE. We're also looking at a slight negative divergence between price and volume on the NYSE. And then we're still seeing some negative divergences with the 200 period and 50 period moving average study. I didn't put it on here. I have a 20 period moving average study. We want to keep an eye on this. We want to see these charts improving. Right now, they're showing a negative divergence. Then the transports, these are not improving. The transports are negatively diverging not only from the Dow, but the S&P 500. In a more solid environment, we want to see the transports doing well. They've not been doing that well. Small caps, even though they had a great week, they still continue to underperform when we compare them to the S&P 500. The dollar, even though it was down a little bit this past week, it's still been rebounding since the beginning of 2024. Dollar strength is usually negative for stocks. And then we're looking at a ratio between the NASDAQ 100 and the Dow, and we're hitting that all-time high level. In fact, we're starting to go above that. And I'll show you that chart. And we're also seeing the negative divergences with the moving averages on the charts that I'll show you here. And we're coming into a time, usually at the beginning of March, we see positive seasonality, but then after the first couple of days, we go into a period of weak seasonality. Here is the fear and greed index as measured by CNN Money. When we get above the 75 level, that's when we're getting extreme readings with this indicator. And you can see we can stay up here for a while, and we've been up here for a while as the market's been going up. But at some point, if this starts to turn and go down, we're probably going to see prices going down as well. Now, one thing that was interesting, after Thursday, we had a reading of 79. After Friday, we had a reading of 75, and we went up in Friday's session, and this index actually dropped down. Just an observation. Here's the skew index. We use this in conjunction with the VIX. The bottom area, here's the VIX. The VIX measures looking at the money options to measure what's going on as far as fear and greed. The skew index looks at out of the money options. When we start to come up into this red area, the market is expecting some kind of a big move. We're not necessarily sure what direction that move is going to be, but they're expecting something. And we've been coming up and then coming down. We started to drop down here, but then we were going up with the S&P. But in Thursday and Friday session, we're starting to go back up. We're not quite into this red area yet, but if we go into that red area, the market is still anticipating something kind of big. Whether it will be positive or negative, we use other charts to give us better context. This is the S&P McClellan oscillator, where it is improving and it's above zero. So that in that fact, it's positive. But as the S&P has been going up, we've been seeing lower readings overall with the McClellan oscillator. That's a negative divergence. Then the next indicator that goes with this is the summation index. It is turning and starting to go up, both based on price and volume, but we've also been seeing longer-term negative divergences as the S&P was going up. This is the NYSE McClellan oscillator, also above zero and advancing, but when you compare it to the S&P, showing a negative divergence. Then this is the NYSE summation index based on price and volume. They are showing some improvement, but when we compare them to the S&P, they have been negatively diverging. We want to see if this shows any signs of improvement. Then this is the slight negative divergence that I was talking about. This is the NYSE where we just look at common stock. The top area is price. The bottom area is volume. We're starting to break out above these previous highs based on price. We haven't broken out yet based on volume. We want to watch this. We actually want to see volume leading price. And right now we're seeing volume trailing price. We want to keep an eye on that to see if that continues. Then this is Dow theory, traditional Dow theory, where we're close to setting all-time highs with the Dow. We're just going sideways when we look at the transports. I'm not including the utilities here. They're in a pretty solid downtrend. When we just look at the transports themselves, we're just chopping around. We haven't been able to get back up to these previous highs that we've set in 2024, let alone 2023, and then earlier in 2023, and then the all-time high set back in 2021. We want to see this really going up, and we're just not seeing that right now. Then this is a ratio between the transports and the S&P, and you can see how the transports are really underperforming and really kind of severely right now. Then here's a ratio between the small caps and the S&P. Yeah, they were up strong, but the S&P was up too. When you compare them with each other, the small caps are still continuing to underperform the S&P. The dollar, it did pull back a little this past week, but since the beginning of 2024, it has been going up, which could put some pressure on stocks if the dollar continues to go up. Then here's the 20-period moving average study compared to the S&P. We are seeing a negative divergence. We're showing some improvement here, but as the S&P was going up, we were seeing these ratings going down. That's a negative divergence in the short term. Then we have the long term. This is the 200-period moving average, also a negative divergence, and we are improving, but we're seeing that negative divergence with the 50-period moving average study. And then this is the ratio between the NASDAQ 100 and the Dow. The NASDAQ 100 are growth stocks. The Dow are considered more value stocks. And we hit a high back in 2000. And then after that was the dot-com bust. And it took us many years to get back up to this level. We finally got back up here in 2021, only to experience 2022. We've been inching our way back up, and we're actually going above this ratio right now. Now, the perma bears love this chart, and they use this chart and only this chart to suggest that the markets are just going to fall apart, and that might happen. But we need to use other charts to get some other context. There's a lot of real positive things happening in the market right now. So you don't want to base everything around just one chart that you're seeing. Now, it could play out this way, and things could shift over and look negative at any time, but we can only go with what we're seeing right now. Then we look at seasonality. This is the fourth year of a new president, tends to see the most gains later, where we're hitting some difficult times in February. Now we're coming into March where we see a little bit of a bump up, and then we see some weakness going into the mid to latter part of March. When we do see gains during an election year, they usually come after we see this downward move. And we really haven't seen any negative seasonality to any degree, at least yet. This is another look when the sitting president is running for re-election. We follow the green line where we do see some weakness going into the mid to latter part of March. Just something to be aware of. It doesn't mean that things are going to play out exactly like this, but when you look from 1949 to 2023, that's a pretty good record. And they take the average of what has happened during that time. We just want to be aware of this. Thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. I hope you have a great week, and I will talk to you in the next video.